Hi, Jerht Santos here of the Coach PH. Remember to click the subscribe button to be updated with our latest videos.
My next question is, how do you manage risk? I know you mentioned it a while ago, but just to be more specific, how do you handle the number of stocks in your portfolio?
Yeah, I mean, first it was, I thought by spreading it to at least 20, no more than 5%, that will be managing my risks. But as mentioned, it also limited the upside. And so eventually, because of that learning from Warren Buffett, when he said, focus on your winners. This point in time, I have only about 11 stocks, and maybe my top four stocks will account already for close to 70% of my holdings. So I am still working on the selling side, on the risk management side, but especially those with losses. The last maybe 10 years, I've gotten ahead a bit of myself. I've understood that I made those mistakes and I will cut losses. But for the longest time, I was not cutting losses. I thought averaging down, it's down 50%. I buy some more. So if it goes back up, I make 100% on the investments that I just put in. But it doesn't work that way over time. Again, I think what one has to understand on the risk side, you have to spread your investments. It's not just about one asset class, all equities. I mentioned to you earlier that eventually I had my own one portfolio and then my real estate, my property investments. It's good right now because you have REITs. You don't have to, buy a significant amount that becomes illiquid because it's in one property and you're not able to diversify. With REITs, over time, it probably will not be giving you the same income prospects from the other listed stocks, but it will likely outperform fixed income because over time you have property appreciation plus increase in rental incomes. There's escalation clauses, so over time, that is going to outperform your fixed income. It's good right now that you have all those asset classes. Not only that, by now you have banks, asset management companies, and insurance companies offering funds that invest overseas. So you have Asian equity fund, global emerging market fund, US funds, etc., etc. So on managing risks, it's a learning thing for me. It's about also understanding the asset classes. That's what I realized later on. That again, also in my studies, because some people think it's about asset selection, whether you select this company A or company B, company C, company D. But studies have shown that over time, over 20 years, 30 years, 40 years, what's important is asset class rather than asset selection or market timing. Market timing meaning, do I buy now? Do I wait one year from now? Do I wait for the result of the elections? Do I wait for the end of COVID, the pandemic, before I buy, or do I buy now? Over 20, 30, 40 years, timing doesn't matter because no one knows if it's going up or down. So it's asset class. Sometimes you move assets from fixed income into equities and vice versa, and sometimes even out of both and just go into near cash via money market funds. So it's the understanding of the asset classes will be very useful. And again, on the risk management side, always understand what do you think are the key risks. All right. For me right now, I mean, again, in my studies, we've seen that after the last global financial crisis in 2007, 8, and 9, 2 years later, we have the debt crisis in Europe, in the Eurozone. We have the PIGS, Portugal, Italy, Greece, and Spain, getting into some problems on their debt levels. So we now have a crisis, the pandemic, and I would like to think that somewhere down the road, we will see some similar crisis. Some countries already have been downgraded in terms of the credit rating. A lot more countries will experience difficulties in the next 2, 3 years. And in the same manner that during the PIGS crisis, our markets went down, but we were not part of the problem at the time because we're a different cycle. EVAT was put in place in 2004, and our economy was improving. Our debt ratios were coming down. And again, signals to you that those were buying opportunities. You have to understand how you are in terms of problems outside the country, which are impacting our local markets. So all those risk management is not just about minimizing the downside. When you talk about risks, you talk about missing out on the upside, missing out on opportunities. So sometimes people, when they talk about risk, it's all about the downside. Risk management is also about if you're missing on the upside. So you have to learn a lot of things. Again, it boils down to research, research, research. It is expanded, not just locally, but also internationally. How have past events impacted our markets and what were the things that happened after those challenging times?
Based on what you shared, it's really finding that sweet spot for diversification, right? Because if you spread it out too much, it could dampen your gains. I remember
Yes.
Peter Lynch's over diversification or diversification. I remember he mentions that in his
Yes.
book. It's really finding that amount of stocks that works best for you and for your
Yeah.
personality also.
You want to have a couple because even if you think this is the best stock right now,
Right.
if you just put a big amount there, and sometimes it takes time for the market to realize what you're seeing in that stock.
Mhm.
Because as I said, every single day when the market closes, it's in equilibrium. At that particular price, there was a seller and a buyer who agreed. And the buyer is thinking, well, there's an upside to this stock. The seller is thinking, well, I've reached my target and maybe the upside is not better. I will either move on to another stock or move on to another asset class. Every single point in time, the market's in equilibrium. So the market's always right. That is the price at that point in time. So it's very difficult to see, if you're not looking into the future, what could possibly happen, what could be something different that they're not seeing, then, you might be missing on the upsides. The same manner, if there's trouble ahead, you might not be able to cut your losses or you take your profit.
You said that the market is always right. I mean, it doesn't care what price you paid for it. It doesn't know what your cost is. It doesn't know what your target is. But I think that's very important. And you mentioned that the market is always right. And the harder you fight that truth, and I'm sure it's going to be more difficult for an investor, right?
Yeah, and I think a lot of, I'm looking at the sites right now where there are people talking about investments, especially for stocks, especially for beginners. I think they're going into a lot more of the non-index stocks. The same experience that I went through because these are the boring stocks, that the index stocks. But over time, these are the companies that have stable earnings. That in crisis years, the big companies even become stronger. Why? Because the smaller companies get bought out or they fall by the wayside. And over time, of course, there are still big companies out there that will face challenges, but over time, the big ones survive the crisis years better than the smaller ones. And some people think, stock prices can go up 10%, 20% every other day or so. In reality, the earnings do not act like that. The earnings do not just increase that rapidly every so often. So again, it's the understanding of what lies ahead for that particular stock. So a lot of people get attracted to high flyers. A momentum stock is something that's actively traded for the moment. You just look at the ticker, which stock symbol is up there, then you can already identify it. Look at the volumes or even the value traded. The top traded stocks are momentum stocks. But sometimes also those momentum stocks can go either way. Can move up very fast and can move down very fast. So can be careful. It's good that if your investment horizon is 20, 30, 40 years, you may not want to be monitoring that on a minute by minute basis and going to momentum stocks. Of course, there are people who really made very well in terms of a momentum strategy, but you have to read a lot about if that is going to be your strategy. Read a lot, do some trials on how you go to plan your trades and plan your exits. You're a momentum player. There are different strategies. No single strategy in stock investing works for all people.
Right.
You have to find your own strategy. But in every strategy that you create, you have to have an exit strategy, a buying strategy, and a selling strategy, whether it's cut loss or protecting your gains.
You always need to have buy rules, sell rules, risk management rules. But with the nitty gritty specific details of that strategy, it's really different per person, and there's really no cookie cutter approach, right?
Yes, because our risk profiles are different.
Right.
No single pearl. I mean, very few will have the same risk profile and understanding of risk asset classes. Not only that, in terms of our objectives, some might be nearing retirement. I'm very young. I used to say that a good rule of thumb for investing will be 100 minus your age will be the percentage of amount that you put in equities. But because people are living longer and interest rates are very low, I revised that to 120 minus your age. 120 minus your age is the amount you can put in stocks. So, if you're age 20, 120 minus 20, 100% in stocks, fine. You have a long ways to go. Again, depending also on your objective. If the objective was that going to buy a car or a house X months or X years down the road, it will be different. But if it's for retirement, for instance, then, that rule will work. So each one will have to have his own understanding of risks, understanding of markets, their own objectives. That's why all the financial institutions will do what you call KYC. Know your client. They will ask you questions on the risk profile, objectives, goals, understanding of markets, willingness to take 5%, 10%, 15% losses, all those things. Those are part and parcel of what is needed for us to understand ourselves first before we go into trading. We have different KYCs.
Right, sir. For some people, 5% loss is big. For some people, a 5% loss is just a piece of cake, right? So it's really different per person. Let me go to the next question. Like, when it comes to buying, do you buy a stock just for one time, or do you scale into a position after your first buy? Can you share how you do that?
Usually, I don't buy in a single shot, a one-shot deal. No? So it's over time. Because, again, I mentioned that a stock that is relatively cheap could be even cheaper the following day or the following weeks. And a stock that is expensive could be also more expensive down the road. So it's difficult. So I don't buy a position on a single shot. My example is that Jollibee, for instance, favorite stock. I bought last year, March, from low 90s all the way to 210. So 93, I think, 94. And then 116, 130, 150, 170. So it's the reverse of what I usually do in the past, averaging down. This was averaging up. I was still buying as it was moving up, all the way to 210. Because I still feel at 210. But my objectives, but what I see down the road, it's still cheap at that price. Of course, my risk profile is different from the rest. So if it goes down 10%, 20%, I might still be smiling because my objective is that, well, there's this story behind me on why I'm buying that. And if it drops some more, and if I have more funds, I can reallocate funds and to buy some more of that particular stock that I like. Right. So no, hindi siya one time. Hindi siya one time talaga. Yung mga speculative ko, sometimes one time yan. But there's a small amounts. The big amounts, my main positions over time yan. Over time. Then it was going up, I'm buying some more. If I was wrong, I can buy some more going down. So ayokong all bets in one go.
And hence, it's very important to know why. Why you're buying it, as you mentioned, sir.
Yeah.
Story. There's a reason why you're buying even at these levels and accumulating. And it's different per person, right? My next question is, when it comes to stop loss, do you use like a fixed percentage, or what is the maximum percentage that you use when you follow stop loss?
When I started, I never had any stop loss. So sometimes my positions took years to recover from my mistakes. I recall it's oil scan. No? I never took my losses and took, I think, 7 years before I went back to the price I initially bought. So that was a mistake. That was learning for me. And then sometimes some people say, well, 5% might be good. And sometimes you get whipsawed because if you sell at a particular price, sometimes it's hard on you if the stock price goes up to buy at a higher price.
Right.
You have to overcome that emotion, that thinking that, and you don't want to make that mistake. No, I sold at 90. I won't buy at 95 because the stock price went up and you were whipsawed. So again, not much rule of thumb, but early on also I mentioned that 3 fluctuations when my target prices were hit, I will do that. On the cut loss side, for the longest time, wala. But if I was employing technical analysis for my speculative stocks, may cut loss ako doon based on my readings of the chart. All right, so hindi siya percentage. It's the chart patterns. If there's using a channel, for instance, resistance and support, then I look at that. If this is broken, support is broken, and I sell. Or if resistance is breached, then I can add some more. So depends on the approach that I was using in a particular stock. Eventually, I mentioned that if I was making a lot of good percentage returns on my investment, then I will have a trailing stops. So the stops could be on profits, and the stops also will be on protecting your losses. Also, the stops does not work just on cutting your losses, but also preserving your gains.
Right.
No single rule. It's hard. I mean, it's stock by stock, and over time lang, you just look back and what were the lessons learned from that particular trade. No? If you do that, keep looking back at what happened, what went wrong, that makes you a better investor in the future. If you don't look back on what happened, then you could make the same mistake down the road.
Right.
So if you keep looking at lessons learned, then you minimize doing the same things in the future.
Right.
Very unpredictable talaga ang stocks. Very unpredictable. I remember also one stock, PTNT. It's listed data pero hindi na actively traded o baka suspended. I don't know the status of PTNT. I bought it at 65 centavos. Then it went up to 3 pesos. Galing ko. And then it went down to less than 2 pesos. Sayang, I should have sold at 3 pesos. It went back up to 3 pesos. I sold. It went all the way to 12 pesos, 13 pesos. So, you can never tell. So early days on. But buti lang isang broker, pinaiwan akong 10,000, 6,500 worth. Imagine the times 20 siya in less than a year. That was my biggest win in the shortest possible ETF. At the time, simula lang yung mga going digital, going cellular. So I thought AT&T was a good bet, but they never got into the cellular business. But there was a lot of speculation then. So things like that. Jollibee, that was the educational plan for my kids, as you mentioned in the introduction. I bought mine at 10 and 12 pesos. So I said, I sold at 90. I said, wow. And then I sold. I was so happy. It was trading at 25 PE at the time. I said, it went all the way to 300, 20, I think. That's why when it went back to the 90s, I said, this was the price I sold decades ago.
Right.
And I started buying back when 90s was hit last March 2020. So sometimes, your past experiences gives you some memories, good or bad, but again, it's a learning thing for me.
It's like you went to a time machine and the Jollibee price is back to 90.
Yeah. It went all the way much higher because the earnings expectation at the time was very 30% growth per year because they were expanding rapidly their business operations.
So when
So
you
hindi
have
ako limited. Yep.
Yeah.
So
sorry, I wanted to know more about the trailing stop. So when you have a winner, your target has been hit. A while ago, you mentioned about having a 5% trail stop. Do you employ that now, or it still depends on the stock?
Yeah, well, kasi nga, I mean, sometimes, yes, in a bit, pero yung positions ko ngayon kasi, that top 4 stocks ko, it's for a long term. So halos, I won't be afraid. Unless there's a spike in the price and there's a spike in the volume, then I don't mind pag-out ka agad. Kasi, the expectations that, it's gonna go down. You saw my post on Facebook when Bitcoin reached 20,000. Sabi ko, Eiffel Tower ang ginagawa niya. Eiffel Tower goes up there, then come down. And true enough, it went back to below 5,000. Of course, it went up again to 50,000. Another Eiffel Tower in the making. So again, if you look at those technical analysis, you will see some formations that repeat because especially for Elliott wave, they say it's behavioral science because the emotions of the average investor does not change very much all the way from the early 1900s, even to this day. People get too greedy, that's why they keep buying stocks and they get too afraid and they keep selling. And again, that's why Warren Buffett's saying that buy when there's blood on the street, be greedy when people are fearful, and be fearful when people are greedy. Just saying, when people are greedy, sell it to them. Be a nice investor. Okay, here's my stock. It's all yours. I'm helping you. You want more stocks. And if you're very fearful, stock prices are way down, I will be a kind investor and buy your stocks. Help you out with your circumstance and give it to you. Obviously, I pocket the gains over time or avoid my losses. My views. Those kinds of things. Again, these are from things that have been experienced by other people, and you will have your own idols and people who you can learn lessons from. Lahat ata ng my books on investments at the house runs several shelves. Because when my wife and anyone who wants to travel, my only request, buy me books on investments. Ako lang, gusto ko lang lahat ng knowledge nandyan. Sometimes I can use this and that, so also confuses me at times as well. Because I know a lot, and it makes my approach difficult and hard to explain in simple terms to an average person. But again, it boils down to research. Right? You can't escape that. Investing in markets, you don't have that time to just place your money in, with fund managers. Regular investing, just set aside money every month. So you do what they call as peso cost average, meaning you buy, let's say, 5,000, 1,000, 10,000, depending on your income or what you can set aside. If the stock prices are down, the index is down, you're buying more shares. If the stock prices are high, you're buying lesser shares because you're investing a fixed amount. But it's better that if you set aside 15 to 20%, even 30% of your annual income for the future. Because it's either enjoy now or enjoy later. Because if you use up all your income right now and spend it, you will see that when you reach retirement, the social security programs will not be sufficient.
Right.
Retirement plans for the companies, 1 month for every year of service is the minimum requirement of law. If you serve the company 40 years, very few of us, because people are very mobile. They move from one company to the other. But even you work for one company for 40 years, that's 40 months of salary, right? 40 months, that's not even 4 years.
Right.
That's 48 months, right? So 4 years. For me, it's not even enough to buy my medicines for maintenance, my maintenance medicine. I worked 40 years and I'm getting something like 13,000 monthly. So that's my pay in the late 80s.
Wow.
So you can't depend on social security programs and your employer provided retirement plans. If you are transferring from one job to the other and you were in the final job for 20 years, that's just 20 months. That's less than 2 years. You really have to set aside for your own personal retirement account. So hindi pwedeng balakan. You have to set aside for your own. And the earlier you do that, the better, because there's more time to compound your money. And the higher you set aside for today, the better it will be for you, because there will be ups and downs of the markets, we know. And it's a learning curve. And, but again, it boils down to over time, you start understanding markets early on, you will have all those lessons learned so that when you retire, you can have those behind you and help you manage your funds. Because I see a lot of people, when they retire, that's the only time they start investing, and they will pay the tuition fee when they have no more future income. And they will incur losses. That is not the best way to prepare for the future.
And the risk is bigger. I mean, for someone who's already retired.
Yeah, you're a beginner, you have a lot of funds, but no recurring income moving forward. You're depending on that to carry you through for the next couple of years or decades. So, not a good idea.
In the next video, we will talk about PhilInvestor's advice for newbies.
My last question would be, what would be your advice for those who are starting to invest in their 20s, in their 30s?
If you have any questions in this video, please feel free to comment below. To get a copy of PhilInvestor's book recommendations, click the links in the description box. Thank you for watching. Click the subscribe button and see you on our next video. God bless you!